Is it a week in the stock market at this point if we aren't seeing asset prices fluctuate all over the place and headlines looking like we're entering August of 1929, right before the Great Depression? Case in point, over the past week, the equity markets tumbled from midweek on from recently achieved all-time highs as investors mulled over the likelihood of the Federal Reserve policy tightening as well as interest rates raising as soon as March 2022. Seems like something we recently spoke about. But let's not be quick to forget that this is still following an absolutely fantastic year for the stock market as well as most other asset classes really, had you just stayed invested and continued dollar cost averaging into the broad market. This definitely has come at a price though that we're now starting to really feel as investors, where it's very difficult to create returns on cash holdings, but on the flip side, there's also been quite a bit of asset inflation pretty much across the board over the past year, leading to higher underlying valuations that have the market at somewhat of a fragile point of uncertainty for many investors. Hey everyone, my name is Griffin, and let's just get right into it because over the past couple of weeks, there have been a few key pieces of data released that can give us a better idea of what might be on the horizon for 2022. And before we get into speaking about where we may be headed from here on out in regards to investments, well, it's important to get a proper measure of the economic growth that we've experienced over the past 2 years to determine, well, where do we currently stand in relation to back in 2020 when things weren't too pretty. Because just like in this book called How Will You Measure Your Life, where we get indicators and metrics to measure our life progress, well, in this video, we need to first understand how we're going to be measuring economic recovery and where we currently stand in relation to all the amount of money printing that we've seen over the past couple of years, which is going to be the starting point for everything else that's to come. Spoiler alert, it comes down to job growth, but more on that later. So ultimately, the reason why we've seen so much asset price inflation over the past 2 years comes down to interest rates. I know, sounds pretty boring, but I promise if you just stick with me here, it's going to be more interesting than your 12th grade economics class. You see, the Federal Reserve has the job of trying to strike a balance between interest rates and inflation levels, all of which leads back to attempting to keep the economy, inflation, and the number of jobs in check. But as we've experienced over the past 2 years, this has proven to be a very difficult balance to strike. And fast forward to today, inflation is running rampant at a level that's much higher than previously anticipated. So to counter this, Jerome Powell, this guy right here that you've seen me mention numerous times on the channel, is kind of in the hot seat, where over the past 2 years, his monetary policy has unquestionably helped keep the stock market from utterly collapsing. But now this has led to higher levels of inflation pretty much across the board and across most industries. At this point, you might ask, what happens now? Well, there isn't much else that can be done than starting to raise interest rates, but the speed at which these interest rates are now being projected to be increased over the coming months is significantly faster than what was previously anticipated last year. And ultimately, this is what's been rocking the markets and keeping them somewhat stagnant over the past couple of months. And just this past week, there was some new information that was released from a meeting held in December of 2021, flagging concerns from policymakers about worsening inflation, which signaled more aggressive intervention by the central bank. Realistically though, nothing all too shocking at this point. Basically, the Federal Reserve is just now reassessing how quickly they're going to start tightening monetary policy to keep the US economy from overheating amid high inflation, which for the record, I had mentioned a month or so back that this could definitely be a possibility. And typically speaking, the stock market doesn't react too well when the Fed starts hiking rates, especially at a quicker pace. And from here on out, if the Fed continues to increase this pace at which it's increasing interest rates, and we might even see a couple surprise rate hikes along the way to help tame inflation, well, this is where we could really see some negative repercussions in the stock market and some steep pullbacks over the course of 2022. Okay, so I mentioned earlier that job growth was one of the economy's primary measuring sticks and that we'd be revisiting it. Well, here we are. To put things lightly here, when a large percentage of the population is out of a job and is just sitting on their couch collecting checks that were printed the day prior, obviously this isn't necessarily a good thing for the economy. And that's kind of what happened at the beginning and middle of 2020, unfortunately. And with this in mind, let's remember that the Fed had previously mentioned that it would feel more comfortable starting to raise interest rates once it's seen some gradual economic as well as job recovery in order to really start cooling down that overheated economy from all of the financial easing that we've been seeing over the past 24 months, which again could lead to an all-around asset bubble, which some investors have been warning about. Now, over the past couple of days, a new report came out stating that there were over 199,000 new jobs added to the American workforce, which for the record did fall short of analyst estimates for the month. However, 2021 remains a relatively strong year for growth in the job market, with an average of around 500,000 new jobs having been created each month of the year. And even though job growth did fall short of analyst estimates in December, well, it fell from around 6% in November of 2021 to below 3.9%, which is extremely low and similar to pre-pandemic levels. Okay, I know that was a lot of information to take in, but all you really need to take out of this is that at the current rate of worker participation and the employment rate, the Fed is considering the economy at this point to be already close enough to what they consider full employment. So ironically, what's actually somewhat of a good measure in regards to the growth and recovery of the economy has translated over into the Fed looking at raising interest rates at a quicker pace in the face of rampant inflation, which in turn is not a good thing for the stock market. I know, kind of confusing, but think of it this way. At the beginning of Jerome Powell's term, he was looking to further expand economic growth through the use of cheap debt, right? You could go and get a rock bottom mortgage as well as low interest rate loans to do other forms of investments, which is what has led to where we're at right now in the first place. Whereas now he's being more hawkish, as it's termed, meaning that in the face of everything we've just spoken about, he's looking to discourage the amount of economic growth fueled through the use of cheap debt. The market is then using this information and turning more bearish towards the valuations that it's giving certain asset classes, notably certain stocks in the stock market that are fueled largely by debt capital, meaning growth stocks primarily. So because it'll then be more expensive to borrow for investment purposes, this will have the effect of slowing down overall asset expansion and capital flowing towards them. Just take a look at the amount of money that's flown towards the equity market over the past year. This is in direct correlation with low interest rates and the amount of money that was printed. But even despite these market worries and short-term news scares, if you're a long-term investor, this really shouldn't be a surprise to you at this point and ultimately should not really change the way that you invest in the first place. All right, so what's happening in the markets then? Well, for one thing, big tech hasn't necessarily had the best past week. And again, it is what currently leads the NASDAQ as well as the S&P 500 in terms of overall rate, where we can see higher valuations across the board. Realistically though, when we zoom out to gain some more perspective on these positions, we're not looking at anything too alarming for the time being. Okay, so as always, lots is going on in the markets and we are seeing some shorter term volatility. What's new? But what can we do to prepare over the course of the coming months for a possible market downturn over the course of 2022 once higher interest rates do actually come into effect? First off, as investors, we need to consider that it's extremely possible that we'll see the markets trending sideways over the course of 2022 and maybe even longer. Having the insane amounts of gains that we've been seeing over the course of the past couple of years, of course, is something that is completely out of the ordinary and is not sustainable long term. If we see the S&P 500 continue increasing at, let's say, an average compounded rate of 20% per year, we'd be looking at astronomical returns over the course of an investment career, which is just not going to be the case. And as mentioned in previous videos, I've continued buying into dividend stocks to increase my portfolio's income over time and simply reinvesting any of that dividend income back into those same positions, as well as dollar cost averaging into broad market index funds. This is something that, even though right now we've been seeing massive levels of appreciation over the past couple of years, even if we do experience a stagnant year this year, over the long term, these are market funds that are going to continue appreciating. So I like to just continue increasing my overall positions in broad market index funds, and I have multiple videos speaking about some of my favorites that I'll leave down in the description. Now, interestingly, even though we are seeing higher levels of inflation right now that is deteriorating cash values, well, I am still keeping a substantial amount of cash on the sidelines to continue buying on the dips and also buy into potentially a larger correction in certain tech stocks specifically over the course of 2022. Now, I know that sounds somewhat counterintuitive, keeping cash even though it's not making any interest right now, and it's also facing deterioration from inflation. But my logic here is that I'm very confident that some of these top companies like Amazon, Apple, as well as Google are going to continue leading the market in the S&P 500 over the course of the coming years, in the coming decade really, as these are companies that just have such a competitive advantage that even if we do see, despite these higher underlying valuations, their value drop over the course of 2022, these are companies that are going to experience much more company as well as financial growth over the course of the next decade. So keeping a cash reserve on the side is something that I like to personally have for, yes, that emergency fund aspect, but also have that money to be able to dollar cost average on the dips in some of my favorite positions. At the end of the day though, it's important to remember that despite YouTube thumbnails or titles, well, none of this really scares me. If we see a market correction over the course of next year, considering my current risk level as well as my investment horizon in front of me, this is just going to be a further opportunity for me to continue buying into the markets for that long-term hold. My take on this in starting to invest in the stock market years ago has always been that staying consistent with your contributions is always going to be better than not staying invested and not continuously reallocating more funds to your portfolio and just reassessing which positions you're allocating money to, right? I've had viewers over the past 6 to 12 months comment multiple times that the markets are way too inflated, way too high, and that it makes no sense whatsoever to be investing right now. Well, look at fast forward to today, we're seeing all-time highs just last week. Now, this does not necessarily mean that it's going to continue, but the point is that over a long enough period of time, if you continue buying into the markets, you're going to come out ahead. Bottom line is that the media though is flooded with both bullish as well as bearish articles about the market, and I'm just trying to make sense of all of this based on my personal experience and take on things. But who knows, the market might continue to expand over the course of 2022. However, things are more lined up to be seeing a more flat year. So make sure to comment down below what you think the market's going to be looking like over the course of 2022. And if you need to open up a brokerage account, make sure to check out the links down below. You can get 3 free stocks valued up to $4,500 each when you open up an account with Wealthsimple. And you can also get 3 free stocks with Moomoo if you're American and you open up a brokerage account with them. Now, also don't forget to check out all the links down in the description for other resources I use and recommend, like my full stock market investing course. And on that note, thanks a lot for watching, and I will see you in the next one.